Welcome to the Whitwam Wealth Real Estate Podcast. And today we're going to be talking about the current real estate market.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam. Glad you joined me today as we discuss the current real estate market. I think probably the best place to start off with when we start talking about the real estate market is the days on market. Days on market are a good indicator, especially for us investors, of how long it's going to take on average to dispose of a property. This also can lead into how long it'll take you to rent a property. Days on market is ever changing, and whenever we get the real estate reports and pull statistics and stuff, I'm always looking at days on market because it has to do also with market saturation. How many days is it going to take you to sell a property really has to be considered when you're investing in a property. So if you're going to buy a property, we'll say from a wholesaler, and it has X amount of dollars in it, and you build in your remodel costs. Well, how much are you going to be paying for your money after the project is done? So let's just say you buy the property with hard money, which a lot of our, I know a lot of our investors do. We use other people's money in our investing, and so we want to get that money turned as quick as we can. And if a project's going to take you 90 days to get it done, and then your days on market are an additional 90 days, you're going to have your money for 180 days, basically 6 months. So days on market really affect us, and days on market are kind of a good indicator also of how quickly things are moving in any given market. Now, obviously, every area of the country is going to have a different set of days on market. I was looking at one of the Midwest cities the other day that's pretty hot, and their days on market were really low. They were under 30. But I looked at some of the major metropolitan markets and seeing days on market at 70, 80, and getting close to 90 days on market. And I would imagine there's probably markets out there that you're in that are over that. And so I always encourage our investors to take a look at days on market. One of the things that was really interesting is how days on markets have increased, and we expected them to start to decrease in September when the Fed cut interest rates. And we're going to talk a little bit about interest rates a little bit later, but generally as market conditions improve for buyers, it would lead to lower days on market. The market that I'm in here in the Phoenix market was running about 75 to 76 days on market on average. Now we got to remember on days on market, because it is an average of everything that is out there, there's a reality. The best houses at the best prices always sell the fastest. And houses that cost less always sell the fastest. So for instance, condos, townhomes, and single-family residences that are on the lower end of the market are going to sell much faster. Now, everybody's market is a little bit different. So if I'm in Houston, Texas, the average sale price is going to be $389,000 or somewhere around there. So houses that are on the market for $300,000 or less are certainly going to sell faster than houses on the market for $750,000 and above. And I think we see that in pretty much every market that we're at. In the Phoenix market, where I'm at, houses that are $350,000 and less sell much quicker. Generally, what happens in metropolitan areas is because housing prices increase, the average cost to buy a house increases for a buyer. A lot of times they'll start to look to the suburbs, and the suburbs prices typically are a little bit less money. And as those costs, as the suburb prices grow, people move farther and farther out, and it puts more pressure on the days on market on things that are in metropolitan cities. And one of the things I thought was really interesting when I was looking at days on market, there's a lot of smaller markets out there that aren't the Houston, the New York, the Miami, the Phoenix, the LA, the Sacramentos, that are not those cities, but they are a little bit hotter, I would say. Days on market are less. Houses are selling a little bit better. There's a little bit more spread and opportunity available. But days on market have been increasing and staying pretty high nationwide compared to where we'd like to see them and where we expected them to go with the drop in interest rates. One of the things that adds a little bit of complexity to our market, especially for you guys who invest on the East Coast, the Florida, Georgia, the Carolinas and Tennessee, right up and down that seacoast, is you just got hit by a couple of hurricanes that were pretty hefty right in a row, and it did some major damage. And we've reported, on our real estate update that we do about those situations. But what I've started to notice in those markets is that there are people that have been through enough of these hurricanes that they've decided that they don't want to be in Florida anymore. Maybe they don't want to be in Georgia on the coast anymore. And so it's actually opening up an opportunity for real estate investors. A lot of real estate investors get looked at as kind of the bottom feeders. They're coming in trying to get the houses as cheap as they can. They really don't care about the status of people. But really what our market does, what real estate investors, we have a really interesting niche to fill in our society. And that is, we should be able to help people in the process of doing real estate investing. So when there's tragedies like this, there's going to be people whose houses were damaged so severely that they can't repair them and fix them up. And they're going to need real estate investors to come in, buy these houses, be able to fully gut them, remodel them, and rebuild these communities. And I think that one of the things that you're going to see in some of these areas that were heavily damaged by the hurricanes that came through, especially up in North Carolina and eastern Tennessee, is that there's going to be a lot of people up there that decide that they don't want to be there anymore. They want to move to an area that has a different weather pattern. They don't want to have to deal with the rains. They don't want to have to deal with it. And they certainly don't want to have to deal with trying to rebuild the houses that were destroyed. And as investors, we have the opportunity to come in and help these people, by acquiring those properties and giving them the money they need to relocate, and then taking on the rebuilding of those communities. And so I think in this, there's going to be a real market trend on the East Coast where we're going to see a little bit of an increase in investor opportunities. We're also going to see on the retail side of things, I think you're going to see properties that are listed for sale that are at a little bit of a discount. And if interest rates, which we're all expecting them to pull back a little bit, if all interest rates do start to fall, it'll create some buying opportunities and probably heat up the East Coast real estate market a little bit and create some opportunities in that area. So if you're investing in the Carolinas and you're investing in Georgia and Florida, there may be some opportunities for you in certain pockets of those states as we move forward here, because it's going to be months for the restoration process to take place. And over this time, like with any place, there's going to be opportunities to I don't want to say take advantage, because I don't want to be like we're taking advantage of people, but to take advantage of the market changes that are out there, because we can, again, help people and we can rebuild communities at the same time as real estate investors. And it wouldn't surprise me that at some point that you'll see some of the hotter cities out there be cities that are in these East Coast areas where we've seen some transition with the hurricane activity that we had out there. There is a real move with and trend with some of the hotter cities. I was really interested to see the growth of real estate and the trend and how hot Austin, Texas has stayed, Kansas City, Missouri, Philadelphia, and some of these type of cities, some of these major metropolitan areas, they still seem to be doing really well, and there's a lot of investor opportunities there. I think that these cities like this, like the Houstons, the Denvers, the San Antonios, they're going to become even stronger when we get to some interest rate pullback. Now, obviously, in September, the mortgage markets had adjusted to anticipate a Fed interest rate cut, which we saw of a half point in September, and rates came down to the lowest that they'd been in 2 years. Rates are still actually for a retail buyer, they're still lower than they were by almost a point from a year ago. So, I mean, that's obviously good news. Interest rates drive a lot of buyer activity, and it's one of the reasons why the investors that I hear from are questioning, why aren't their houses selling? Why are the days on market so long? We've got the nicest looking house in the nicest community. It's because money's much more expensive. And even if you're playing the long game and think interest rates are going to come down, you still have to be concerned about today's payment as a homeowner. And so interest rates are driving a lot of what we're dealing with in the economy. And we were expecting, some big Fed rate moves that would continue the downward trend, but we've seen just the opposite. We saw a period of several weeks that after we saw some drops, some rise in rates, we've got a lot of transitions that are going on right now. And whether or not December, January, February are going to continue a trend of Fed rate cuts and decrease interest rates is going to depend on the economy, which really has not gone the way I think that the Fed expected. When they dropped rates by a half point, they thought that they were on top of inflation, but we saw inflation start to tick back up. It won't be until we get deep into November when we actually be able to look back and get a better gauge of where things really sit. But I think that overall we're going to see, the last part of November and into December, which are typically slower seasons, I think we're going to start to actually see people start to come back into the market as the market adjusts to the economy. At some point, they're going to get hold of inflation. They're going to bring rates down. They're going to get a handle on spending. And I think we're going to see the economy, an economy-driven market, and some changes that we haven't seen for about the last 3 years. One of the things that I keep hearing bandied about, and this affects us as real estate investors, is the unemployment rate. If people don't have jobs, they don't have money in order to get loans, no matter what the interest rates are. And with interest rates up, they need good paying jobs in order to afford houses. But one of the biggest things I think that the financial guys get wrong is looking at the unemployment rate, because that's a number that can be manipulated. And we see it all the time. You get unemployment news that says, hey, unemployment is only at 3.8% or it's at 4.1%. And then 3 months later, they quietly adjust those numbers. We've seen it several times in the last 2 years where those numbers have been quietly adjusted, and the numbers that they put out really weren't accurate. And those kind of things really drive an investor market as far as what are our rentals going to be, what are rent rates going to be, are we going to be able to sustain this type of rate of return on our multifamily or single family type properties, or as a flip investor, are we going to be able to turn these over? As a wholesale investor, am I going to be able to keep and build the margin that I need and still give my investors an opportunity to buy properties that they can make a profit on? And really, instead of using unemployment rate, what we should be using is labor participation rate. Because labor participation rate really tells us how many people are actually working in the economy. It really tells who's working and who's not working. That, along with GDP and our inflation rates, can help us determine how aggressive we can be as the economy starts to turn around. How far out in front can we get in some of these areas? Because there's some areas I think that are starting to show some really positive signs, but how aggressive do you get there? Are interest rates going to come down enough that by the time we get done with our projects, or long-term on our buy and holds, is it going to create the margins that we need or want in those areas? I know here in the Phoenix area and some of the other areas that we've looked at around the country. Right now, I'm not pressing hard in the Florida area, just simply because I'm going to give it a little bit of time to heal, even though I think there's some great opportunities for guys who are aggressive in those areas. But when I look at areas like Houston, Las Vegas, those kind of things, I think there's a lot of potential upside over the next year in these markets, because I really think that interest rates are going to be favorable to us. I do think we're going to get a handle on inflation. I do think that our economy is going to begin to churn and turn around for us, so that some of these investments, in fact, as we've got some development investments that we're in, and we got some more that we're looking at on the East Coast, out in Virginia and some of those kind of places, that are all based upon this. Where are we at with our days on market? Where are we at with inventory levels? Inventory levels have been increasing, which normally you would say would be good because it gives buyers more opportunity. Well, in a thriving economy, it would be good where our interest rates are right. Overall inventories are up almost 1% year on year nationwide, and that's a pretty good jump for the amount of inventory that we have. Our inventory here in Phoenix has probably gone up close to 30%. Just over the last year is the amount of inventory becomes available. And some other major markets are experiencing the exact same thing. So I think that some of the foundational things that we need for an economy to return, which is inventory, which inventory will help to stave the price of homes from continuing their increase, their appreciation, which will help to cap inflation in the housing sector a little bit as the economy gets spurring again. And then I think you're going to start to see an escalation in home prices. I think that you're going to see an escalation in incomes. And I think you're going to see actually a little bit of a cap on inflation, which is going to help because it's going to make building new homes much more affordable for new builders and some of those kind of things. So I think that right now where we're at with with our real estate economy is kind of in a really balanced area. We need interest rates to come down. We need more inventory to be available, and we need homeowners to feel more secure about the job potential, so that the market continue to move a little bit farther and get moving forward for us. You've been listening to the Whitwam Wealth Real Estate Podcast, and I'm at the end of our time for today's episode. I want to thank you for taking time to listen. If you found this episode on real estate markets helpful, be sure to subscribe and leave us a review. If you have any questions, we'd love to hear from you. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcast, and YouTube, or even wherever you get and enjoy listening to your podcast. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.